Well, moving from those software stocks to bonds, the rapid rise in rates have many more interested in fixed income. And our next guest has been crunching the numbers to see which bonds are best. Let's bring in Tom Tzitzouris, Director of Fixed Income Research for Strategas. Thanks so much for coming in today. We appreciate it.
Yeah, thank you for having me. It's great to be back in Toronto.
Oh, yeah, it's nice to catch you while you're in the city. This week, the 10-year Treasury yields hit above 4%. What do you make of what's happening right now? What's driving things?
Yeah, well, this is really being driven by a stronger than expected U.S. labor market. Despite everybody's call for a recession and the labor market rolling over, it has not happened yet in the U.S. Yeah. And not only that, but you're seeing continued wage pressures, albeit not necessarily accelerating, but wage pressures which remain elevated, and a demand for labor. And today we saw jobless claims did not come in as expected. They came in lower than expected. So it's telling us there's still a fight for labor. What that all means is that the Fed's job is not done. So what the market has done, the bond market has done in the U.S., has priced in about another 75 basis points of rate increases over the last month. So now the market's saying a terminal Fed funds rate, 5.5%. And by the way, this is not a U.S. phenomenon. This is a global phenomenon. The global markets, bond markets, are pricing in more central bank tightening around the world, even if some central banks have paused for now. And so you're seeing this filter through the entire curve. And the U.S. curve is really no different. But we saw a lot of pain today. And we've really seen a lot of pain in the last month in the U.S. curve.
Yeah, 5.5%, but there's talk of even higher, right? Yeah. The possibility of 6% terminal rate for the Fed.
Yeah, and there's a lot of folks probably in the Fed who are pushing that narrative. Now, we don't think that's going to happen. But there's no argument that says they can't go that far. It really depends on how much of this, quote, call it excess demand they want to wring out of the system and how much labor market pain are they eventually willing to tolerate. What we do believe will happen here is that eventually the U.S. labor market will feel the pain of higher interest rates, and you will see unemployment begin to rise, at which point in time the Fed probably pauses and does eventually cut. But how far do they get? How high do they go before then? Right now, the bond market's saying somewhere at or above 5.5%. And right now, I'd take the bond market on that.
How much weakness do you think the Fed wants to see in the labor market? And I wonder because, have things changed over the past couple of years with the pandemic, having such an impact on the way people work, on where people work, all sorts of different things. And then the labor shortages that really have driven those wages higher in some areas. Have things changed in a way where the Fed might not be able to get what it wants or what it wants to see with the labor market?
Well, I don't think the Fed has ever been able to get, quote unquote, what it wants. And that is stable employment and stable prices. The two are very hard to deliver at any one time. The last decade was unusual where we had both. But most of the time, unemployment's either rising or declining, and inflation is all over the place. So what do we think the Fed wants right now? Ideally, they'd probably want to see the unemployment rate rise by 0.5% to 1% and inflation come down to about a 3% CPI inflation. That is doable, but more likely what will happen is once unemployment rises to, say, a full 1 percentage point rise, it's going to be pretty quick to go from a 1% rise to a 2% rise.
Right.
So they're going to find the labor market is wobbling faster, and eventually they will have to cut. But for now, they're looking for about a 0.5% to 1% rise in unemployment.
Yeah. Do you think it is a slippery slope? Like once you get that 1%, like you said, that we could see labor markets weaken quite substantially, because if whatever it took to get that little bit of a change, does that automatically mean that there's going to be more? I mean, that's a really difficult question.
It is difficult to answer, but I would say this. Much of the U.S. labor market is very susceptible to a pullback in consumption, even a small pullback in consumption. Another way of saying this is that we have a lot of employment in, say, the services sector, particularly restaurants, hospitality, leisure. And those are areas where there's probably already labor market or job hoarding. That is, business owners are reluctant to lay people off or fire people, despite the fact that productivity is negative. And so what you'll likely see is when consumption does pull back, you'll very likely see a rise in unemployment in those areas of the economy that's quick It's rapid, and there's a bit of a contagion effect. Probably doesn't cause the economy to go into a very deep recession, but nonetheless, there could be a substantial rise in unemployment in many, in particular, lower income and middle income households.
So let's come back to fixed income side of things. Where should investors be looking right now? And should there be, a rush to do something in this moment, or sort of a wait for what?
Yeah, well, when you see this type of selling, whether it's bonds or stocks, it always tells us someone is caught off sides and there's a positioning issue. So until we get to that jobs market report tomorrow, positioning could easily drive yields higher, or we could reverse lower. But the big picture now, with yields where they are, whether you're looking at the front end of the U.S. curve or the back end, Treasuries look attractive at these levels. 4% plus across the entire curve pretty much looks attractive to us, longer or intermediate term.